back. You're watching the market. If you look at the Nifty, we're about 500 points away from the all-time high. And with that, I'd like to invite my next guest, Venugopal Garre from Bernstein, who's written a really interesting report recently titled India Strategy 2022 Outlook, Bubbles and Cycles. It is in this note where Bernstein talks about getting a 40% plus return from the equity markets in the last 2 years. Is it possible? If you look at their targets, no, they seem to be neutral. They're expecting the year to end exactly where we are right now in the month of January. In fact, they're talking about creativity creeping in from all quarters, whether it's from the government, corporates, startups, to justify the kind of valuations that we are seeing. Venugopal, thank you so much for joining us live today on the market. Tell us, why are you expecting neutral returns this year?
Thanks a lot for having me on the show. So I think you've really summarized it well, but there is no major tinge of negativity. I mean, it's a genuine neutral. The perspective simply for us is that, this title of bubbles and cycles represent things really well. So if you were to think about 2 years of strong returns, and off the lows, of course, we have sort of doubled in terms of market. Valuations are above averages across sectors. There has been broad-based returns across sectors and stocks. It makes it very difficult to sort of generate absolute returns from here. So that's where this dose of creativity comes into picture to justify not just the market levels, but to get further quick returns from here, which is what we are of the view that it might take some time before you tend to see the time value correction or more consolidation of the markets rather than a quick returns immediately. The second thing just to quickly highlight is that, this reason why this bubbles word was used is because whenever you tend to see bull cycles emerge, after 1 or 2 years, you start to see excesses develop in certain end markets. Now we're starting to see that signs of some form of excess valuations and optimism emerging in some parts of the market, not necessarily market, the broader economy in certain sectors. And however, once you reach a certain situation where that particular end market becomes so important for the markets overall, and that bubble pricks is when you tend to see deep corrections. Now, we don't really see us in that situation, that we're going to see deep corrections because of a significant bubble formation this year, but that's something which is a monetary for us. So that's where we stand. We think that broadly from a macro standpoint, we're still moving in a broadly upward sloping curve. That's going to be a support for you, but we have to be very selective in terms of, where we get in for generating that return.
What are the chances that we could be in for a big earnings surprise? Because typically when credit growth starts, when consumption starts, earnings, they will surprise us like they've surprised us for FY22.
Yeah, so, the point of view is here is that if you look at the overall earnings construct, we've already seen primarily a fairly strong EPS growth, if I were to say, for the previous year. There have been earnings upgrades as well, but somewhere down the line, we did see a stall in terms of the upgrade cycle. So what does it mean for here? This is, if I look at the forecasts for the next 2 years, we're still building in above normal growth of earnings, which is more than 20%. And I think we're still building in above normal macro growth. Now, every other parameter, including a credit growth, eventually shapes up in how macro fashions out, how earnings sort of get forecasted. For us to see surprises from here, I would probably say that we need to have a much deeper and a more powerful cycle from here, which is what I think will be very important. Now, somewhere down the line, we still feel that we are in a situation where after the initial rebound, we're still sort of sideways moving from an economic standpoint. It might still take some time before we establish a case for a very strong upcycle. Maybe to something which we saw 2003 to 2008, perhaps. So which is where you probably see powerful overall market earnings construct to shape up. Now, the second thing is, of course, there are opportunities within certain sectors for you to see, or within sectors and some stocks to perhaps see much better than expected earnings, which is where the sectoral allocations perhaps become relatively more important to play.
So where do you think large part of the heavy lifting will be done for FY23? Because that in a sense becomes the new focus in terms of understanding.
Yeah, so I mean, if you were to look at it, it's very clear that domestic micro cycle related end markets have to really power up. And I would say that something like financials, for example, where credit growth has been relatively meager, there has been sort of still some form of reversion in the system. If you were to see over the next, I would say 12 to 24 months, if we were to believe in a positive cycle, we have to actually see that as well accelerate. So, and not just that, also in a rising macro, improving macro, if things don't turn for the worse, you would also see, the credit risk sort of coming down over a period of time, which also leads to the comfort in the banking system or the financial system to relatively lend for maybe slightly higher risk projects, not necessarily super risk. So to some extent, that has to be one of the major areas where you need to see some degree of heavy lifting. And also a smaller sector, which is outside of that, is primarily related to things like industrials, which is capex oriented, I would perhaps say, which also usually in positive cycle tends to see positive lifts. Those are usually very difficult to forecast because they could be very non-linear as well, but not very big from a part of an index standpoint. But that's another one where you perhaps see some degree of positivity.
Okay, so that's as far as, of course, the outlook for 2022, Venugopal. But in 2021, you had also written a note where you had said, can powers be the FANG from India? Where powers was, P4 was Paytm, representing fintech, O was for Ola, representing all the cab aggregators. You had W for Walmart, that owns Flipkart. And then you had, of course, the Z, which was supposed to be Zomato, the apostrophe S was for Swiggy, as well as Byju's. With all that's happening after the note, you've had a Paytm IPO and all of that as well. Do you still hold this view?
Oh yes, as I had mentioned broadly in that thematic, is that as far as the next 10 years is concerned, we are fairly certain of a very strong digital economy shaping up in India. And digital economy, of course, doesn't necessarily mean individual stocks, which are pure digital plays, but also the digitization within the normal corporate world, which sort of improves efficiency and things like that. Now, having said that, the broader construct for us remains the same, not about individual stocks again. It was a representation of the digital economy that we still remain positive long term. But if you sort of notice in our 2022 outlook as well, we sort of, from a tactical standpoint, believe that, we decided to take the view that incrementally, at least in the near term, we should be a bit cautious, especially because if you look at globally, most of the EM tech stocks have seen a huge correction. So on a relative valuation basis, the digital stocks in India, not just in the public markets, but also in the private markets, tend to see a situation where they are, I think, in a slightly excess zone from a valuation standpoint. So that's one risk that we need to play with. And secondly, if you were to really believe we're somewhere in the middle on that, on an overall tightening of liquidity, actually impacting the markets, in some way in the long term, or let's say in the 12-month time frame, you tend to see models where profitability is too far out in the future tend to get more impacted, especially from a discount rate perspective. So that's very tactical in terms of viewpoint that we want to go neutralish on the digital economy from that perspective, rather than taking an all-out view that we should take a negative view over the next 10 years.
So you're saying this creative storytelling at play even in the private markets. You're saying everybody's indulging in creative storytelling, from the government to corporates to startups. So the one question I want to ask you is then, how should one cut through the noise? Because at the same time, on ground, you're seeing a pickup in manufacturing activity. You can see what's happening with tax collections. You can see the GDP growth also coming back. So you said financials is one way to be overweight on, but how else should one cut through this creative storytelling that you've written about?
The main perspective simply is that, after you see a situation where there is a significant directionally upward movement across the board, you need to be careful about then which stories you want to really believe in. So for example, everything in India is a story. Infrastructure has always been a story. We were supposed to have 100 stations modernized by now. We were supposed to have a Navi Mumbai airport and a bullet train, probably even, in a situation where we higher visibility right now. PLI, for example, is very good long term, but the expectation is that, it's going to transform the economy in the next 12 to 24 months. We were supposed to have power sector reforms, Electricity Act, electricity bill, and reforms which will suddenly lead to a transformatory change in the entire power sector within 12 months, and those 12 months have been going on for a while. So this is what I call it as dose of creativity. When you believe all of these things simultaneously will happen in 12 months to 24 months to justify valuations. That's a broader context of what creativity basically means. So what it means is reality check, be very careful about what you get into. So for example, you will see a lot of IPOs which are going to happen from digital stories this year. Don't want to name them, but quite a few of them are sort of early stage, and some of them are very immature business models. Largely meant to sort of tap capital because you're getting easy liquidity, and also gain from the excess valuations for the original shareholders. So when you look at these, you cannot have a blanket buy saying that, hey, this is the first of this particular end market, so let's just buy. Be very careful on what you're looking at is a broader thinking from us. And this holds good for the normal listed stocks as well, that within the financial sector as well, you need to perhaps focus a bit more on quality rather than, going all out at this juncture and buying anything. Probably that was okay last year, but not necessarily this year. So this is the fine line, in terms of how we portray, stock selection.
Okay, let's see how all of this pans out. For now, Bernstein expecting neutral returns. If you look at the targets that they've given for the year end at the start of 2022. Venugopal, you said you're not going to get into specifics. I know you track one of the big IPOs that's coming on, which is Delivery. SEBI approval is in. IPO could be before the month end. So we'll get you back on the channel another day to talk about that hot space. For now, many thanks for joining us live today.